Hi, friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And we were not planning to do another episode because it is currently Good Friday. So we're technically
Also, it's
off.
a market holiday.
And it's a market holiday.
The markets need a break. Just shut them down.
But Jerome Powell gave a speech at, I think it was like Chicago, the Chicago Investment Club, that Jen basically took as like him almost giving the giant middle finger to Trump. Trump made a comment that Jerome Powell's termination cannot come soon enough, which he's currently, his term runs out May of 2026. However, the term termination leads you to believe that he might be considering firing him, which there's been kind of speculation for a while as to whether or not that would happen. And so I want her to talk a little bit about that, but also like what the implications would be of firing the chairman of the Fed, because whatever Trump wants, like it would basically honestly just make the whole situation worse. So that's my feeling. And anyway, Jen, you can correct me or explain what would actually happen. But so there was a meme going around that was like, stage a walkout for Jerome Powell on Friday because everybody's off anyway. And then we also wanted to touch on a couple other things that are going on right now. So the fight between the administration and Harvard and pulling funding, because I think it's like the dumbest thing to do to cut research funding to these elite institutions. And it's something that I think that if you just hear about it, you're like, well, they have these huge endowments, like just use your endowment money. So we wanted to break down a few things related to that little fight that's going on. And then finally, big tech breakup conversations are back in the news with Zuckerberg in court as the FTC is basically continuing something that started in the first administration under Trump 1.0, was continued under Biden. And then now they're going after Facebook, trying to potentially break them up, Google, and a number of other tech giants. So
yeah, Googling. Google's the one that just had the ruling, right?
Yes,
within the last 24 hours.
Yeah. So again, Meta is currently in court. Google, there was a ruling that just came out. So we've discussed this in the past, but I think for a lot of you who are new, basically, what exactly does it mean to be broken up, and how would that, by the way, impact you as if you're a shareholder, and what do these different terms mean? So that's the agenda for today. So why don't we go ahead, Jen? We can kick it off and talk about the Fed.
Yeah, sure. I mean, listen, if you are not a trained reader of the Fed's remarks, sometimes it just seems like a lot of gobbledygook, or at best, like a very political phrasing of things that can seem at the outright to be saying a whole lot of nothing. But the Fed uses very specific coded language to communicate because they know that if Jerome Powell orders coffee, whether or not he got it with like almond milk or oat milk or whole milk, could move the markets. So they are so careful about how they communicate, and they communicate very deliberately, right?
And I want to add one other thing. You used to say that when basically Powell would make statements, you guys would literally take his statement at the last meeting, his current statement, and if there was a comma out of place, it would be like a huge deal. Like that's the level of detail that we're talking.
Yeah, exactly. So, sorry, it was the Economic Club of Chicago, not the Finance Club. So when Powell spoke at the Economic Club of Chicago last week, he delivered a series of prepared remarks and then responded to questions. I'm assuming he had those questions in advance. I don't know. But without reading the entirety of the prepared remarks here, basically what he said is like, listen, we don't know what the ultimate impact of tariffs is going to be. We are obviously watching growth metrics. We are also looking at price stability and trying to see if the impacts of inflation are still being felt, right? So that basically sounds like we don't know, whatever, which is kind of how the whole rest of the market feels, by the way. But in Fed speak, that is extremely hawkish. And if you remember in the past, we've talked about being hawkish versus dovish as the jargon that we use to explain the Fed's attitude. So if the Fed is dovish, what that means is they are erring on the growth side. They're concerned for that half of their dual mandate. And that is pointing towards easier monetary policy where they would be doing something to stimulate growth because that's the side of their dual mandate that they'd be concerned about. And if they are hawkish, it means that they are more concerned about rising inflation, that they are erring on the side of concern about prices rising too much. Therefore, they would need to tighten monetary policy either by raising rates lowering their balance sheet, et cetera, et cetera.
And I want to add one just like personal data point. I got an email from the baby brand that we use for our stroller and car seats. I literally bought a new car seat for my new baby coming because, fun fact, did you know that car seats expire? So we bought our first infant car seat in 2018 and it expired. So they sent an email saying that they're raising prices because of tariffs. And I mean, not in an insignificant way. I think that the average price in some of their items are going up like $300 or something, which again, like for new parents, that's huge. This is like the main baby brand that if you're in New York City, you walk around, it's like everyone has an Up a Baby stroller. So, you're already starting to see the impact of these tariffs already.
Yeah, I got all our baby stuff from Nuna, which is I think Norwegian company.
Mm-hmm. And I mean, by the way, Up a Baby's American. Well, Up a Baby's American. It's an American brand, but they do manufacture in China. So yeah.
But so back to the Fed. When they want to say like, hey, we have basically like taken the cover off the bazooka and our finger is on the red button to like release the hounds and basically try to save the economy, their language might be like, we are monitoring growth and thinking about like they use this very measured language, but that's their code, right?
Yeah.
And so it's not like they're going to say like, aha, we're here, we're riding in to save the day, right? They will use this coded language to signal what you're supposed to look at. Not only did Jerome Powell not do that, but he spent a lot of time, again, talking about concerns for price stability. So what that basically means is they're conveying what we have said on this podcast pretty much nonstop for the last 2 weeks. If you are relying on the Fed to come in, make sweeping rate cuts, start expanding their balance sheet based on what we know now, that's not what they're planning on doing. I think he unequivocally conveyed that message that ain't happening anytime soon. And so I think the questioner actually asked him point blank, basically like, is there a put, right? Like, is there effectively a level at which you will come in and stabilize this market right now? And Jerome Powell was like, no. And it's funny because I was talking to a couple people afterwards, and if you're not used to reading these statements, you might just say like, oh, well, he kind of said, we don't know what's going to happen, therefore we can't do anything. Well, if you've got people like Jamie Dimon coming out and saying like the Fed needs to do something to get us out of this kerfuffle, and you have so many people thinking that the Fed is going to come in and save the day, Jerome Powell saying, we don't know, is him saying, I'm not coming. I'm not helping you out right now. And so in response, I guess on Truth Social the next day, Donald Trump went and said something on the order of magnitude of basically Powell's termination, right? Like the end of his term as Fed chair can't come soon enough. And the Fed should have already cut rates by now. So, I mean, them's fighting words, right? And I understand that obviously Donald Trump does not communicate necessarily in the same conventional ways that many other presidents have in the past.
You're not looking to see if there was a comma out of place.
Yeah. So exactly. So this disconnect between what's happening at the White House and what's happening at the Federal Reserve is a central tension that we had kind of been concerned about coming into this administration, and now is kind of front and center. So where does this leave everything? To be honest, I mean, I think stability is all the market is looking for. The market is looking for direction and certainty about what is going to happen. And until we know exactly what these tariffs are going to look like, what Jerome Powell is saying at face value is true, that we simply don't know. And we can't really make decisions. You can't invest confidently if you don't know what data points you're supposed to be evaluating, right? But I do think that threatening the independence of the Fed, basically, which is something that is literally written into our government. It's very important that the Federal Reserve stay an independent institution. Now, we can argue as to what extent it does get influenced by party politics and things like that. But the bottom line is that the president does not dictate monetary policy, and that's an important part of how our government functions, that it does not. So the Fed chair can be removed for wrongdoing. If Jerome Powell, I don't know, went out and drowned a bunch of puppies, there's obviously limits to his ability to stay in office if there's actual wrongdoing. But making monetary policy decisions with the information that you have that don't necessarily coincide with what the administration wants is not wrongdoing, right? And so if you totally alienate or discredit the Fed, that's only going to cause more market instability. and God forbid you were to all of a sudden threaten the chairman of the Fed's, at least seeing through the current term of him being in the seat, I think that is way scarier for the markets than the Fed not acting.
I just don't understand what Trump thinks lowering rates are going to do, because we've mentioned this before, that it's like you lower rates, that's going to impact the short term, that doesn't necessarily move the long term. So, okay, you can come in and do some quantitative easing. That's, again, a whole reversal of policy, but that's different, in my opinion, than just lowering rates. So I assume, though, he means come in with some quantitative easing. But even if you do that, even if you lower interest rates, it doesn't, I mean, maybe it's because like my background is more on the corporate financing side, where it's like, I think about an income statement. It's like you've got your revenues. Now you've got a huge potential spike in the cost of goods sold. The cost of borrowing, well, for some companies is meaningful, for many companies it's not that meaningful. The big issue is that cost of goods sold piece. So I don't know what, again, the lowering of interest rates is going to do for
the lowering of interest rates is massively impactful because it incentivizes investors to move out of the safest securities into the riskier ones. So that is what the lowering of interest rates does. It's not about the cost of corporate borrowing. It is about how you incentivize investors to allocate their capital. So remember, right? What happened in COVID when you lowered interest rates to zero? All of a sudden, everyone went out and bought equities. Everyone bought a house. Right. But I mean, part of that too was like flooding the stimulus as well. There were a lot of people that were getting checks from the government sitting around with nothing really to do. I mean, they now had extra spending power. So, and by the way, there's a lot more day trading. So there's a lot of reasons for why there was that increased push into equities. That was, again, like, I 100% agree with you that that's obviously like a big thing with the market dynamics and the theory and all of that. But again, as we kind of go back to saying, like, let's look at, again, we're impacting the short end rates. And again, maybe his goal is not only do the short end rates, also start some quantitative easing. But if you think about the way that the equity markets are priced right now, we're still at very rich PE multiples from a historical perspective. And the actual impact of the tariffs from a profits perspective has also not been priced in to the full extent. So it's like, if you think about just the valuation of this individual asset class, what the impact of the tariffs is going to be.
Yes. So that's why I'm like, again, I fully agree with your assessment, but it's like, the problem is this external thing that is unrelated.
The problem is the bond market, right? You can set rates low, but if you have a total wholesale lack of confidence in the US bond market, it doesn't matter where you set those rates. The market will set those rates for you.
Right.
The one rate that you can set. That is the thing fundamentally at the end of the day. So when the Fed acted the last time, the Fed and the US Treasury had full credibility in the eyes of the world and in the eyes of the market. You know what it is? It's like when you live on the island of Manhattan. I remember thinking this all the time. There's like a handful of rules that were like keeping society together, but it like actually hung on like a knife's edge. And I used to think about this, like if someone stole your taxi, like if you were in line and like probably for some of our listeners they're like, what's a taxi?
Yeah.
Like, back in the olden days before Uber, you would be walking down the street and you're facing a certain direction of traffic and you'd hold up your hand to hail a cab. And if you saw someone who had their hand up for a cab, you would automatically kind of like file in line behind them. If you wouldn't leap out in front of them on the sidewalk as you see a cab with its light on pulling up, like raise your hand and be like, oh, this is my cab. And it's these very simple things. But occasionally it would happen that like someone would steal your cab and you would feel like the entire social rules that hold everyone together, like fraying. You're like, if this doesn't hold true, nothing is real. Like, you can't have 9 million people on this little island and have 100%. Us all live together if we can't agree on this basic principle. It's the same thing with the global financial markets since 1947 or whenever the U.S. dollar became the reserve currency of the world.
But that goes back to this whole point of like lowering rates. Again, especially on the front end of the curve. And even if you go and you start being a marginal buyer in the bond market itself, like if other people are losing faith, and by the way, if God forbid Trump fires Jerome Powell, I think that it's going to be a even bigger shockwave. Like it's going to do the complete opposite. I think that the actual impact is going to be that instead, I mean, you can lower the rates and fire the chairman of the Fed. Rates are going to freaking go up. I mean, that would be my view as a non-expert.
I don't necessarily know exactly which direction the market would go in because it depends on so many other things.
True. Again, what do I know? But it just seems like
No. I'm not saying you're wrong. I'm not saying you're right. But it causes a much bigger problem, which is these policy moves exist in this world where there's certain laws of physics. So if you go out and shoot the chairman of the Fed in the head, all of a sudden the laws of physics are no longer holding true. So whatever monetary policy decisions you make now are in a world where like, hey, gravity might not work all the time.
Yeah.
And now we have new laws of physics. So that's what's so much more concerning. And, it's funny because like we're off the highs, we're off the lows. The market feels like it's just kind of hanging out, waiting for new information.
Yeah.
And that's fine. I think the Fed told the markets it's okay to wait for more information, but it also told the markets that information is not, I'm coming in on a white horse or a white helicopter with, bags of money to drop on your heads. Right. So that's where we are right now, as far as the markets and as far as monetary policy goes, in my view, at least. And by the way, there were other speakers from the Fed out this week who were even more hawkish than Powell was. So he doesn't exist in a vacuum too. We give so much weight to what he says, but there are other Fed governors who go out and speak all the time, and the market is just as closely watching their tone, and their tone has been hawkish as well.
Yeah. Well, again, I think that there's a lot of similarities to what happened with COVID, just in the sense that there is, again, this massive supply chain disruption. There's a lot of companies, obviously the Up Baby example, but you have all of these companies that either had manufacturing facilities in China or potentially elsewhere. But again, the ones that have it in China are going to be hit the hardest, because the way that it works, right, is if you're operating a business, you're building up your inventory. You only have so much inventory that's physically here. That inventory is over in China. And like, if you were supposed to spend $100,000 for whatever it was, your product, now all of a sudden you're spending $100,000 to the Chinese manufacturer, and then you're writing a $145,000 check to the US to get that product. So that's $245,000 where, by the way, you hadn't budgeted for that. You haven't thought about that. And so that has to now all make its way through the system. So again, it's a very similar, almost like supply chain issue, like what we saw in COVID. So I don't see how, unless something is worked out quickly, because companies did not have the lead time to shift manufacturing or to build up more inventory, right? Or to like figure out alternatives. So getting product and inventory is going to be a issue in the near term. Again, back to what happened in 2020. And we did see inflation in 2020. And yes, obviously the Fed cut rates to zero. There was a stimulus too, but we did end up with inflation. But so yeah. So anyway, fun stuff. All right. So the other thing we wanted to quickly just chat about was what's going on with the Trump administration and Harvard and some of the universities. So the Trump administration sent a letter saying, if you don't meet XYZ demands.
Well, I think you should frame why they have demands. Specifically, these universities are being accused of violating the Civil Rights Act. I mean, there is like a codification for what is happening. This is not just like hey, we don't like what you're doing. It's the administration is saying this was a clear-cut violation of the Civil Rights Act. There are consequences for doing so.
Yes. But again, they're going after a number of universities, some of whom were obviously much worse actors than others. I think Columbia is kind of like your poster child for just completely dropping the ball with regards to like how they handled everything. But again, there were a lot of universities that did not handle things as they should have. So now the Trump administration has basically sent a letter saying, if you don't meet XYZ demands, some of which are basically figure out the shit with regards to anti-Semitism, but also like you have to get rid of all DEI hiring. Like you can't look at diversity in any way, shape, or form in the application process. However, you do have to have like intellectual diversity, and we're going to come in and we want to basically be able to monitor. There was whistleblowing things that were put in place about like how people could basically blow the whistle on other people, but dictating who could be hired, who could be admitted, and a whole bunch of other things, which Harvard basically said, like, this is going a step too far, right? This is too much on the government intervention side, and we are not going to accept that. So what the administration is now saying is we are going to not only revoke your tax exempt status, which to me, I've talked about this before. I don't really care if the tax exempt status is revoked. I think in general, this will probably get me canceled, but like, I think churches should be paying tax. Like, I think like everyone should be paying taxes. That's my 2 cents. But they also want to cut research funding. And they also were talking about not allowing Harvard to accept foreigners, which that is, in my opinion, like trying to kill the goose that laid the golden egg. Because as a society, I mean, by the way, this is research funding that's going to, I mean, my God, like robotics and stuff that's helping with our national defense and like pediatric cancer. And, you know, it's interesting. There was a really great episode of the Odd Lots podcast where they kind of just explained how NIH funding worked. Because again, so much of it is, if you think about like where this research comes from, there's private institutions like the pharmaceutical companies. You have the NIH, who does have people who do it on site. And then they also outsource a lot of it to like the best and brightest minds in the world, which are at our elite institutions. And this, by the way, benefits us as a society, right? They talk about this in the Odd Lots podcast, that there was this like lizard that
the Gila
monster that people noticed could fast for long periods of time. So they decided they were going to study the Gila monster.
They studied its venom.
Yeah. So they basically took the saliva. And by the way, that is now our Ozempic. So like there's huge breakthroughs. It's also with the mRNA vaccine for cancers and stuff. And so there's so many things where it's like, there's these maybe things that seem stupid on the surface that actually then become these huge breakthroughs. And I remember as a kid, like learning about where did penicillin come from? It came from moldy bread, right? So there's accidental discoveries that happen all the time. And your large pharmaceutical companies and other institutions like that, they're not going to pursue those types of just like asking questions type of research, because it doesn't, there's the timeline to make it monetizable is so long. But there was some crazy stat I heard that like the ROI on the research dollars that are spent by the US government is something like 20%. Like, yes, tons of it goes nowhere, but then it's the blockbuster model. It's the same thing with the pharmaceutical industry. So
I think one thing that's important to address is also why this money needs to come from federal funding and why not from the universities' 100%. Endowments themselves.
Yeah, well, I mean, so with the endowments, like Harvard has I think it's $52 billion, although we'll go through kind of like, again, how endowments actually manage that investment, because they are kind of like little hedge funds. But the endowments themselves, you can't just take you can't take that money and just use it for whatever you want. So that is money that obviously alumni have contributed that are earmarked for certain things, right? For the sports stadium or for financial aid. So it's actually earmarked to go to specific things.
Sorry, just to be clear, you can use endowment money for research. Yes, some money.
Some money.
I actually found a breakdown. There was a big study of, hundreds of different college endowments across America that was done last year. So here was the breakdown of kind of how the average endowment is spent. So the vast majority of most endowments, close to 50%, this study cited 48.1% of endowments is spent on student financial aid. The next biggest bucket is earmarked for academic programs and research. So that is one of the key functions of an endowment, but it is not the only function. You also have other functions like the operation and maintenance of campus facilities. You've got endowed faculty positions. They have to pay some of their teachers through some of these things.
Yeah.
And then they've got kind of like a catch-all, all other purposes bucket of about 17%. But research is in part funded by endowments, but they can't just say, okay, well, we have all 52 billion and we're going to spend it tomorrow on research in lieu of federal grants.
Yeah. And also, I mean, look, Larry Summers did come out. He was the former president of Harvard. And he said, look, guys, like stand up against this. What else do we have endowments for if not for this? But two things. Number one, Harvard is not the only school that they are coming after. Obviously, Columbia capitulated, but there's other schools that aren't going to have that same level of endowment. Brown, for example, where I went, my alma mater, I mean, I think that our endowment is closer to like $5 billion, which again is great. But I mean, like the level
average
of
university endowment is something on the order of magnitude of $234 million.
Yeah, exactly.
So like these are really, when we talk about $52 billion, that is in no way representative of what
they are the largest
college endowment look like. They're but like by an order of magnitude that's so massive. Right.
Yeah.
So, and again, even Brown and Princeton at $5 billion and $38 billion respectively are still behemoths compared to the average university endowment.
Right. So back to that whole point is to say that you're not going to continue to fund research grants, which in my opinion, it's like, this isn't necessarily just for the benefit of Harvard. It's more like the benefit of society. And then also to not allow them to take foreigners. Like, look, I'm about to have my fourth kid. Would I love it if my kids could get into Harvard and not have to compete with foreigners? Sure, right? Get like some of that amazing competition. But no, like, I mean, that goes back to sort of the reason that the US has always been the cutting edge of everything is like people want to come here. We get the best and the brightest from all over the world. And so to say that you can't have the best and the brightest come to study here to then do the research that then, by the way, become like the American companies that use this research and develop these amazing products. It's like throwing a freaking stone in the middle of the sort of engine that is literally, again, the center of innovation for all of America and killing the goose that laid the golden egg. So I don't necessarily disagree with some of the things that they want to have change, but like, this is not how you go about it. I don't understand how this is actually okay.
Yeah, I mean, I think it's funny. I think there is so much consensus around what the problems are in, call it like, deficit spending and things like that in America. The tariffs seem to be the wrong solution, at least in the eyes of the markets, right? And having this conversation about what endowments can and cannot do, what federal research funding actually goes towards, who actually benefits, it seems to me very similar. It's the wrong answer to the right question. I do not support in any way, shape, or form the Civil Rights Act being violated, period, full stop.
Yeah.
I think we can all agree on that premise, that Civil Rights Act, you violate that, you're in trouble. Okay. But what trouble means should be possibly something very different, right? And again, I don't know. I'm not a legal expert. So if it's deemed that a university has violated the Civil Rights Act, aren't there judicial proceedings? Like, isn't there legislative work that can be done, right? Isn't there some proper mechanism for playing all this out rather than saying, let's take funding away from pediatric cancer research, right? And I know not all research is pediatric cancer research. I was talking to someone the other day about like what my senior thesis was. Like, I'm not going to lie. If I had gotten federal funding to research a sci-fi novel, that's not the appropriate allocation of taxpayer money. That's not what it should be going towards. But there's some kid in my class at Princeton who was probably trying to figure out the formula for cold fusion. That's where your federal, that's where I want my taxpayer dollars going. So
yeah. And by the way, that you could put further restrictions on some of what is it that you're studying XYZ. By the way, saying like, hey, I'm going to study the Gila monster. I mean, it sounds kind of ridiculous. Now, again, if you were initially trying to fill out a grant application and it's like, we want to figure out why they're able to fast, right? Like then, again, you can change some of the policies for getting funding. That's fine. If you think that there's stuff that's BS, then you don't like, okay. But to just cut funding, like, I have a problem with that. And it was interesting, there was an episode of the All In podcast last week, and it was Larry Summers, Ezra Klein, and they were debating David Sachs and Chamath Palihapitiya on the tariffs. And it was like everyone agreed on the basic premise of, yes, we want to be able to manufacture.
Everyone agrees.
Everyone agrees. But like, I do feel like when people get too close to the administration, this is for both sides of the aisle, they become like little robots that basically it's like there's one program, just defend without any thought. And it gets very frustrating to listen to.
Let's go through kind of some of the endowment theory, because I think we've touched on this in the past, but for some of our listeners who are new, the way that endowments invest, you refer to them as little mini hedge funds, but I think it's actually interesting to talk about the allocation of their assets. So we just talk about how they spend, right? What endowments money is earmarked for. But I think what's really interesting is to have a conversation about where those endowments are investing and why, because of the nature of when they need to use that money. Yeah. And as you can imagine, right, if it's research grants, but it's also like, okay, well, maybe we need to have something in reserve for like buildings that need to be rebuilt, or maybe we need to open up a new like chair for this faculty 20 years down the line or whatever. So can you talk a little bit about the Yale theory and also like total portfolio composition and how that has evolved for investors like endowments, who are really a critical piece of when we talk about a lot of the engines that move the financial services industry. Endowments are big investors in both the public and private markets.
Yeah, I mean, it's interesting. So if you think about like, if you are interested in going and working at a private equity firm, going and working at a hedge fund, ultimately you're going to need to raise money from someone else to invest. And who are you raising money from? It's these big institutional investors. Your endowments are a huge player. I would argue they're kind of seen as like the most prestigious because they tend to have the longest term investment horizon. Some other players you might have are like pension funds and insurance companies, where, by the way, they oftentimes are going to have a little bit more of almost like I don't want to say an asset liability mismatch, but like they are going to need to plan. But they are going to have, but the point is that like they are going to have to plan to pull money out at some point in the future. Because as you think about just like investing in general, I mean, timelines matter. I mean, this is something personal finance, like we all hopefully understand that, like, you know, if you are and putting more money into your 401k, you kind of just like put it in and theoretically shouldn't really mess with it. You can maybe rebalance obviously here and there, but versus like if you know you're going to need to buy a house, you want to be in liquid assets. And actually my cousin, they are selling their house and like they actually just bought a house, but they're trying to sell their house and they're worried about the market correction because when obviously equities go down, if people have a lot of their investments tied up in like the stock market, they don't want to take that money out. And if they haven't been smart, right?
Did
and
she lock her rate yet, by the way?
I don't know. I need to call her and find out. I don't know.
That was ridiculous.
I will double check. So anyway, the main takeaway here is that when you are basically making allocation decisions about how you want to invest your money, the time frame matters. So you have your pension funds and insurance companies. They have usually some shorter time frames that they need to invest. Again, on the endowment side, they tend to be seen as like much longer term. Because by the way, with these endowments, like the way that they try to use the money is they actually try to grow the pot of money and almost like live off of the returns, right? Yep. They don't want to basically
like
take that down and shrink it. Exactly.
Right?
Yes.
Yeah.
It's like fixed income, sort of, right? Like you want to basically be living off of the returns, again, not eating into the pie, which is, by the way, why people are saying like they have these huge endowments, why can't they use it? And it's like, well, they don't necessarily want to eat into that pie.
They don't want to dip into the principal.
Right. But from a just investment allocation decision, there was a famous CIO of the Yale Endowment, and his name was David Swensen. He came up with the Yale endowment theory, or also called the David Swensen theory. And the idea is you basically take that money and you want to kind of diversify it. So you invest some percentage into equities, some percentage into bonds, some percentage into what they call, the alts. So private equity, hedge funds, real estate, blah, blah, blah. And that's how you kind of think about your allocation. And so we had talked about in one of the prior episodes just how private equity is in a little bit of trouble because if you think about what shifts that allocation as people are making these investment decisions, basically market correction. So if the stock market comes down, it can look like some of those assets that are less liquid start to make up a bigger piece of the pie because they don't get revalued as quickly. But the main point is, if you are Harvard, you probably do have some amount of investment that is allocated in more liquid assets. But by the way, I mean, right now, I probably, similar to wanting to buy a house, I probably wouldn't necessarily want to pull money out because not only have equities come down, bonds have probably come down because of what's going on in rates and credit spreads blowing out. I mean, private credit, same thing. Like nothing, I would not want to sell right now, but that's just a total, kind of different story for different day. Emergency, you're going to have to sell but yeah.
Yeah. And so again, just to really touch on one of those points, it is about the fact that these endowments are not designed to be dipped into for your day-to-day activities, right? It's the income that they are kicking off that is designed for that. Harvard, okay, they are a little bit of an outlier because simply of the order of magnitude of their endowment. So for purposes of having a conversation like that, it does seem like, okay, well, when you have this huge endowment, what's $2 billion? Go plug that hole. This is a way of punishing you, right? But then if you think about the broader principle being applied to other universities, all of a sudden the leverage dynamics shift massively. When your endowment is 200 million or 50 or 100 million, it's a very, very different story in terms of how dependent you are because you simply can't kick off that much income off $230 million unless you get invested in the riskiest stuff. And then you are risking your principal, right?
Yeah.
So the smaller the endowment, the more conservative it kind of needs to be. And then it becomes this feedback loop.
Yeah.
Harvard benefits from its sheer size. The bigger you are, the more of a buffer you have against these emergency drawdowns that may happen, and the more income you can kick off. So it becomes this very positive feedback loop. Yeah. So it's funny, right? Because again, I think just at face value, if you're violating the Civil Rights Act, okay, let's figure out a way to address this. But almost if the administration kind of like should have picked on somewhat smaller first in a way, because Harvard can withstand, even if this goes through and $2 billion is truly cut off and this doesn't get resolved in some other way and there's no negotiation or whatever, Harvard could be like, bye.
Yeah. I mean, and it's going to go through the courts, right? Like that's the other thing is that it's the same thing with what has happened with the law firms.
Start in the courts. Like that's the whole thing. That's where it should start.
I don't disagree. But yeah, I mean, Harvard's going to fight this, and they have the time to fight it because also, I mean, you have a 4-year term. Court proceedings take a really long time to go through, which kind of brings us to the next topic of conversation, which is also related to the courts, unless you have more things you wanted to.
I did also just want to circle back to one other point you made. We talked at length about how, at the end of the day, we both feel that education is the top priority. And one of the biggest potential solves to some of the economic issues that are very legitimate that we all agree on, where tariffs may not necessarily be the right solution. And so we spoke a little bit on a prior episode of this podcast, and I've lost track, about how if we really want to compete with China and we really want to win in a trade war, a huge piece of that is winning in education. And I think we've experienced in the US an extreme stratification in education, where the average outcome from a completely public education is so wildly different at this point from the expected ROI and outcomes of an elite private education in the US. That gap feels like it's only widening as these shifts take hold in the economy. And so if we can agree on the premise that education lies at the heart of solving some of these economic problems, I think the last thing we want to do is cause a brain drain. We do not want to incentivize the best 100%. And brightest researchers, students, et cetera, to say, I think that there are 100% deep flaws in the elite universities. And in fact, part of our mission as a podcast is to kind of undo some of the flaws that have happened from having just a handful of schools that have all the power, whether it be from placement in elite jobs, whether it be from a whole number of things, right? But I don't think that saying, hey, to solve that problem with these universities, we need to scare away or defund the best talent coming to these universities. I don't think that is the solution. So I think the last thing we need as a country is a brain drain. And it is my concern that in trying to solve a real problem, we've come up with a solution that causes a host of other problems.
Yeah, I was going to say, and actually one other kind of interesting point as well is that, if you think about just like the US, what our biggest exports are, I mean, it's so interesting kind of going back to the initial tariff conversation that like it was the reciprocal tariff piece was based on exports related to goods. A huge export of the United States is higher ed. Like that is a huge thing that we are exporting. Foreigners are coming to the US, buying our services, and that's obviously not counted. But are we really now going to want to say, hey, you can't have foreigners buy this service?
It's also the education system in so many of these countries where you're bifurcated out as not being college eligible so early in the process, right? In the EU, in Asia, there are so many hoops that you have to jump through just to even be eligible to apply for university. Versus being like, sorry, you're going straight into the workforce. So it's just such a different pool than it is in America, where it's like everyone can apply to college. So for you to have the wealth and access to opportunity, like it's a caste system in so many other countries. Again, this is what makes the US so wonderful, is that you can come from some random public school in Kentucky and apply to Princeton, right? There is that social mobility, right? Mm-hmm. And with many of the elite Ivy League schools, Harvard just raised the income limit for receiving a full ride, right, to $200,000. We were talking about this last night with my father-in-law, who's here from Switzerland, and it's crazy, right? But like, because of how expensive college is, if you earn $200,000, which is, call it 4 times the median income of an American family, the expense of sending your child, of paying that college tuition,
that's $160,000
poverty line.
Yeah. Well, I mean, if you are earning $200,000, actually, I guess you're probably not paying 50% in taxes, but if you are earning $200,000 and you're paying $80,000 to send your kid to school on a pre-tax basis, gross that up, maybe you have to make $120,000. So that leaves you with $80,000 to live off of, which, by the way, might sound like a big number, but if you have other kids, like it's not. By the way, if you have other kids who are in college,
a mortgage, a car, want to eat food, maybe pay some medical bills,
Details. Yeah.
So again, our goal here is not to be political at all, but I think if we can all agree on what a problem is, then let's propose some solutions that benefit the country rather than defunding its talent. I wish that they had just gone after them to combat the civil rights violations. But it's like, again, you've identified the problem. The solution makes no sense.
Yeah. So speaking of courts, the last thing we wanted to touch on was what's been going on with big tech. And so earlier this week, there was articles about how Zuckerberg is in court and there is a case being made about Meta, well, Facebook at the time, buying Instagram and WhatsApp as like the two examples of monopoly power. Although really it goes a little bit beyond that. So I actually want to back up a little bit. So Facebook in 2012 bought Instagram for $1 billion, which at the time was like huge. It was, I think, a 30% cash, a 70% stock deal, or that was flipped. But basically Instagram employees were getting stock in the about to go public Facebook. And they were a small company, like they were not the behemoth that they are obviously today. So at the time, the FTC was like, sure, go ahead. Now, part of the problem is that I guess there were some documents that Zuckerberg basically came out and said that this was like a buy or bury type of program almost, like they didn't want the competition. And so they were going to buy them because they didn't want to have to compete. And then the same thing with WhatsApp. So they obviously bought WhatsApp, a messaging service. And again, at the time, the FTC was fine with it. Now the FTC is going after them for monopoly concerns. And so the whole thing is that whether or not this is a case that's going to be won is TBD. But what does it mean to say that companies have to be broken up? So what would that look like? Because also Meta did say in 2018 that they considered doing what's called a spinoff of Instagram. So for people who are curious, because you hear spinoff and you're like, I think it means that they're separate, but like, how does that work? So in general, if you are a large corporation, you can almost like split up from some of your different divisions via almost like two methods. There is the sale method where you, again, divest, you basically sell off whatever that business is. So in the case of Instagram, theoretically, like Meta could say, I'm going to sell Instagram to somebody else. Now, who can buy them? That is a great question because Instagram valuations right now, people speculate in like the $100 billion value range. Now, it's hard to know exactly because Meta doesn't make Instagram's revenues public, but I think there was in 2023 estimates between like 40 to 60 or $70 billion. So you can kind of say like, all right, I'm going to slap a similar multiple that, you know, where Facebook is trading or Meta's trading or Snapchat's trading, whatever, and figure out, you know, in theory where this company should be valued. But the point is that like, if you try to sell this business, there's not that many companies out there that can buy $100 billion business.
Yeah.
The only kind of buyers out there that could afford a company like that would be like some of your other tech giants. So your Googles, who by the way have their own little antitrust issues going on, and they also have YouTube. So the idea that another company could buy them is going to be low. Like your private equity player is probably not going to be able to do it. So that brings us to the other option, which is like there's these what are called public market separation techniques where you basically use the public markets to separate out your businesses. And so there's a whole bunch of different options. And I remember when I learned about them, like back when I went through investment banking training, I'm like, there's all these words, I don't know what they mean. But there is something called an equity carve out or a subsidiary IPO, which like Instagram could like take part of themselves public. The problem is if they only take a little portion of themselves public, call it like 10 to 20%, Meta still owns them. So that's kind of off the table. So you then could do what's called a spinoff or a split off. Now, a spinoff is where basically I'm going to sort of put it from the perspective of like, let's say you are a shareholder and you own Meta. Meta then owns Instagram. So whatever, the valuation is whatever the valuation is. With the public market separation techniques, you basically create two separate companies where, again, you as a shareholder then would own both this newly created Instagram stock, right, and Meta stock. So the value of Meta obviously has gone down, but you have probably actually more value than you started with because typically when there are these spin-offs, split-offs, breakups, there's something called the conglomerate discount where these large behemoths trade at a lower price than what they would if they were independent companies because there's like lack of transparency and all that other stuff. So actually, potentially, if you were an investor in Meta, that would be a good thing for you. Now, the other thing that they theoretically could do is something called a split off, which is similar. The only difference is that what happens is if you are an investor in Meta, you would then have to decide after these two companies separate, do I want to keep being a shareholder of Meta or do I want to be a shareholder of Instagram? So you would, if you decide you want to be an owner of Instagram, you would have to basically give up your Facebook shares or your Meta shares in exchange for Instagram shares. So the actual number of shares goes down for Meta. But again, the point is, like, at the end of the day, like, tons of companies resist being broken up, but it's actually probably beneficial for the investors. It's probably beneficial for innovation, for competition. So I don't know. To me, great. It's probably a good thing for anyone who has watched your 401k go down. Like, it might be a little bit of a bump. And by the way, that was Meta. Google, less than 24 hours ago, this has been ongoing and it's been appealed, but a judge yet again has said that Google did engage in monopoly practices and broke the law, and this will probably be appealed. But anyway, so yeah.
Fabulous. Well, that was such a good breakdown. Thank you so much.
Yeah, of course. I feel like we're so in the markets recently. So every once in a while when we can talk about M&A, reverse M&A, corporate valuation, we want to take those chances whenever we can.
I just hope everyone gets to enjoy this weekend, regardless of any holiday that you are celebrating. Let's celebrate the markets being closed for 5 minutes. Like, it feels really good to just take a deep breath, and hopefully things calm down a little bit. And sometimes that can be a wonderful gift to see things with fresh eyes, because I would not want to be trading this market.
No. So anyway, thank you guys. And again, happy holidays to anybody who celebrates any kind of holiday this weekend. And we will see you next week.
Bye.
Bye.